This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through and look at group accounts, and when we look at it, we're going to start off by recapping bits and pieces that you've seen from your F1 exam. I think it's imperative that you understand group accounts from the F1 exam, because if you don't, you're going to find it very difficult to go through there and understand how to do some of the extra aspects that we see in F2 when we start looking at complex group structures, changes in group structures, and the consolidation of an overseas subsidiary. So it's important that you work your way through this chapter and the next to ensure that you're happy before you then move on to the more complex aspects. So if we look at what we have with regards to the consolidated statement of financial position, it reminds us a little bit there about what control is. Normally for you and I, that's greater than 50% of the equity share capital. But we will go through and see a little bit later on that control specifically is the power to direct the activities, isn't it? And you can direct the activities if you own greater than 50% of the equity shares, because that allows you to pass an ordinary resolution, doesn't it? Okay. If you can pass an ordinary resolution, then you can appoint the directors. If you are appointing the directors, then you will appoint your directors. And if you appoint your directors, you can tell them what to do. So therefore, you will direct them what to do, and you have the power to direct the activities of that subsidiary. So the power to direct the activities creates a subsidiary, provided that we own greater than 50% of the voting shares, and then we will consolidate. Can you remember the basics and the fundamentals of how to go through and consolidate? I'm sure that you can. So if we go through there and have a look, essentially we consolidate, don't we, by adding across 100% of P plus 100% of S on a line-by-line basis. So they're property, plant and equipment, and we do exactly the same as it for inventories, receivable, and your cash at bank balance. Remember, there's that additional asset, isn't there, goodwill, which we'll calculate in a separate working, which we'll refer to as working 3, or your goodwill working to keep it simple. The equity, remember, the equity shares. Remember, we're reporting to the parent shareholders. So the equity shares is 100% of P only, isn't it? Okay. And then what you've got is the retained earnings, which is working 5, as we'll see, and the non-controlling interest, which is there as working 4. And the key bit is that your equity section, what that is showing is ownership, isn't it? It's showing who owns what of the subsidiary, because at the top, by adding across 100% of P and 100% of S, that is because we have control of those assets, and we need to show who owns those assets. So that's represented by equity, isn't it? And the equity shares belong all to the parent, so we're showing what the parent owns with regard to the shares, and then they also own all of their retained earnings plus their share of the post-acquisition retained earnings. Careful, a little bit too far there, not to worry. And similarly, in terms of your non-controlling interest, that's showing what the NCI own. So they own the non-controlling interest at acquisition, don't they? Plus the non-controlling interest of S's post-acquisition movements. Again, right at the bottom, we still show control, don't we? By adding across again 100% of P plus 100% of S. Not just the assets at the top, but also the liabilities. So there we've got examples such as loan notes, or debentures if you like, trade payables and tax payable. Add them across 100% line by line. Okay, that's the basis of performing basic consolidation. Remember, the key accounting concept is, can you remember what we're doing? We're not accounting for the legal form, are we? Yeah, correct. We're thinking about substance, and accounting for the substance of the transaction and looking at the group as a single entity, aren't we? And because we look at substance in the single entity, that then leads us to our standard workings and the adjustments, doesn't it? The standard workings there, number one, group structure. You don't have to draw up a group structure working unless it helps you within one of those objective test questions. All I'd note there, who's the parent, who's the subsidiary, the fact that you own greater than 50%. It may be useful to also work out the non-controlling interest, and also as well may be useful to work out the acquisition date or to understand when we acquired the sub. We're then going through and working number 2 is the net assets of the subsidiary, a vitally important working there. So you take the figures, don't we, from the year end. That comes from S's statement of financial position, doesn't it? The share capital and the share premium, whatever they are at year end, remember they will be the same as at acquisition. That figure never changes. You normally need to find the retained earnings at acquisition, which is normally given to you in some additional information within the question. And then you've got some adjustments. A PUP adjustment is what we've seen before, so we'll recap that in a moment, but we adjust S's column at year end if S has sold the goods to the parent and made the profit, and there is still some profit contained within the group. So you've seen that at F1, but this fair value adjustment, what you've got there, that is new. You haven't seen that before in F1, so we shall cover that over the page. If we go through there and then look at your goodwill, working number 3, I don't think you'll find anything too challenging there. So you look at your fair value of consideration, so to you or I, that's looking at what you've paid. It's normally a payment in cash at F2 level, but obviously in F1 we looked at things such as share for share exchanges as well. Don't worry about share for share exchanges. Normally we just are given the consideration in full at this level. You then add on the non-controlling interest. Remember, when you're looking at the non-controlling interest, you either put in the non-controlling interest at fair value, so it's true worth, or you put in, don't you, your proportionate share of net assets. Alternatively, fair value method is also sometimes referred to, is it the full goodwill method? Because if you put in the fair value, it shows not only that the parent's ownership of the goodwill, but also what the non-controlling interest own of the goodwill, whereby if you put in your proportionate share, then that is the partial goodwill, because you are showing there just the parent's goodwill. Okay. If you're unsure, we'll see bits of it in some of the videos as we go along, but it is something that you should be familiar with from F1. You then take the net assets at acquisition, so that's that figure, is it there in working number 2, and deduct that to give you your goodwill on acquisition. The non-controlling interest calculation, you take the NCI acquisition from working 3, so that figure there is exactly the same as that figure there that you've used in working 3, and then you add to that, don't you, whatever the non-controlling interest own of the subsidiaries post-acquisition movement. So the subsidiaries post-acquisition movement is there. That's the figure, isn't it, that goes to working number 4. Okay, so that will go in, and you will take the NCI share of it. Okay. Once you've gone through and done that, you've then got your group reserves. So it's 100% of the parent group reserves, isn't it? Alternatively, you've taken the NCI share of S's post-acquisition into working 4. Don't forget as well that that same figure that we have is also used in working 5, whereby we go through, don't we, and put in P share of the post-acquisition profits, because that's what the parent owns, isn't it, of the subsidiary since the date of acquisition. The other bit that you've got, the adjustment, is the PUP. We will adjust that PUP in working 5, the group retained earnings, if P is the seller, Because if P has sold the goods, then P has made the profit. And if P's made the profit, we need to remove that profit on the goods that are unsold at the end of the year from P's retained earnings. So that's the 5, was it? Yep, 5 workings. I say 5, the first one isn't really a working, is it? Your group structure. But we'll stick with those as we go through. Okay, hopefully you're familiar with them from, was it the glory days of F1, and now you've advanced on to F2. So the one at the top of the adjustment is the new one, which is ever so slightly different to what you've seen previously, given it's new. And all it's saying here is that when you look at the net assets of the subsidiary, we use the figures in the statement of financial position, don't we? Okay, if you go back to working number 2, those figures come from the SFP, don't they? The share capital, the share premium at acquisition are the same figures of what we have at the year end. The retained earnings or the reserves are what are booked by the subsidiary in terms of its profits. And we use that total figure, don't we, to calculate the goodwill. But that's the book value of the assets less the liabilities. What happens if this is the book value and this is their true worth? What happens if the fair value is greater than the book value? Well, what we need to go through and do there is, in our working 2 for the net assets, we need to get the net assets from their book value up to their fair value. So we need to go through there and ensure that your fair values are adjusted through working number 2. And what we have to go through and do there is consider some typical fair value adjustments. Of those, I think the most important one that I've seen most, is your property, plant and equipment. Okay, so you adjust for the fair value difference. So if I have an asset that's worth 10 million, so that's its fair value of 10, and the book value is 8, then the difference is 2 million, isn't it? So that's the 2 million fair value adjustment that goes in working 2. It goes in at acquisition, and it also goes in at the reporting date. It will be the same at the reporting date unless you are told otherwise. Just note as well, there is a bit of an and. What you also need to go through and do as well is the fair value is 10, the book value is 8. The subsidiary will have depreciated the 8. We have put 10 in, haven't we? We've increased it by 2 to get it to 10. 8's been depreciated, but the extra 2 hasn't, has it? So what we'll need to do is, in the post-acquisition period, so at the reporting date, we will need to adjust for any extra depreciation on that fair value adjustment. Okay, and we'll see that adjustment as we go through and look at the example on fair value adjustments. It's a tricky little adjustment, but one that you see so many times that you usually get quite comfortable with it. Okay, whatever you do, when you're there within the exam, do not forget that if you have that fair value adjustment and it's there at the year end, that figure there at the year end also needs to be shown on, is it the group SFP? So it needs to be shown on the face, because if we've adjusted the net assets there as part of the goodwill calculation, then we also need to go through as well, don't we, and put in the fair value adjustment on the face of the financial statement. So here what you would have, if you're looking at property, plant and equipment, it will be 100% of P plus 100% of S plus the fair value adjustment less any extra depreciation. Okay, so fair value adjustments might not just get tested by asking you to calculate goodwill. It might also ask you to work out what the value of your property, plant and equipment is. So there are 2 extra things that you need to take on board above what you've previously seen. Is it there from F1? Okay, so that's just a new bit. Everything else that we now look at and talk about is exactly the same. It talks about other adjustments there, inventory and contingent liabilities. I'll allow you to just go through there and have a look at them. There's nothing too exciting, because most of the time it focuses on PPE, but just be aware, inventory, same principles. You'll be told the carrying value. You need to compare it to the fair value and book any difference between the carrying value and fair value in working number 2 and on the face of the group statement of financial position. Just be careful when you look at inventory. Normally the fair value will go down as opposed to maybe going up. So you need to reduce the net assets by putting it in brackets. Okay. Similar with a contingent liability. A contingent liability is not recognised within S's financial statements. We need to put in the fair value of that contingent liability at the acquisition date and at the reporting date. So therefore you need to go through, and again it's a liability, reduce the net assets, so put the liability in brackets. But inventory and contingent liabilities are rare. I wouldn't worry too much about them. Okay. The intergroup balances, that should be nice and straightforward. If there's trading between the parent and the subsidiary, and there are closing balances between the parent and the sub, yes, legally, P may have a receivable from S, and S have a payable to P. But when we look at the group, that there's nothing due outside of the group, is there? So we need to eliminate the intracompany balances, and you go through there, don't we, and debit the payable. So you reduce the payable on the face of the consolidated statement of financial position, and you reduce the receivable, don't we? Okay, so there, if you so wish, if we go back, is it to the group SFP? On your receivables, you'd be looking there, is it at 100% of P plus 100% of S less any intracompany balance. Similarly, if you're looking at your payables, it's 100% of P plus 100% of S less any intracompany balance. Okay. You'll be told what the intracompany balance is within the question. If we go through and look at the other adjustment that we have, that's your cash in transit. So cash in transit arises when you have intragroup balances that are unequal. And the reason why is because part of the liability has been paid off, but the receiving party has not yet received the cash. So if that's the case, what you need to do is just treat it as a normal cash receipt from a credit customer. So all we go through and do there is we debit the bank and we credit the receivable. Okay, so you debit your bank and credit receivable. Forget the words cash in transit. I don't like those words, cash in transit. Yeah, just think about it as a normal receipt from a credit customer. So what you've got there, if you're looking at your bank, it will be 100% of P plus 100% of S. You debit the bank, so you add in your cash in transit, and again you try and squeeze it in, it's up to you. On your receivables, you remove that cash in transit and then eliminate any remaining intracompany balance. Okay, bit tricky. Last but by no means least is your favourite provision for unrealised profit. So you're normally given a markup. Most of the time I've seen it's 25%, and you need to adjust for the profit on the goods that have been sold, but the goods that are still within the group at the end of the year. So you'll be told what goods are in at the end of the year, either half, 20%, 70% of the goods are still in inventory, and you adjust accordingly. Again, you need to remove the profit, so you debit the retained earnings. Again, that's the retained earnings of the seller, isn't it? So if the parent sold it, we debit the retained earnings of the parent, which is in working, 5, your group retained earnings. And if it's the subsidiary, if the subsidiary has sold the goods, which working do we debit? No, not that one. Working number 2. Okay, the net assets of the subsidiary, because that's where we see the retained earnings, isn't it? So you debit the retained earnings in working 2. Which column, though? No, not the acquisition, yeah, the reporting dates. So you'll see that adjustment at the reporting date column within working number 2 of the subsidiary. And then you need to credit the inventory on the consolidated statement of financial position. So that's a credit to inventory, so you are reducing your inventory. So again, if you want a bit of completeness on your inventory, it's 100% of P plus 100% of S. You credit the inventory, so you are reducing inventory, so you deduct the PUP from the inventory. So it's important that you understand how the adjustments not only just impact the workings, but also impact the face of the consolidated financial statements. So you do need to be on your toes. What you might be at the moment is maybe a little bit, I can't remember anything from F1. Don't stress. There's a few examples over the pages that we will work through slowly together to ensure that you're back up and running before we look at anything more advanced. So whatever you do, please don't panic just yet. I'll see you for the examples in a moment.